I know we're on the air,
Okay.
and we want to welcome everyone to Knowledge is Power Podcast Live. And our guest tonight is Ms. Vanessa Washington, owner of Guaranteed Express Tax Service. Our subject today is going to be about the 2025 and the 2025 tax updates. And we all know as tax season's coming, it's in the next 2 weeks, and we need to be prepared and ready to go for tax season. So here we are as we begin tax season, the beginning of tax season 2025. But we need to know all the different loopholes and advantage that we can take advantage of. And we've got Miss Vanessa Washington right here with us. Hello, Faye.
Hello, how are you doing?
I'm great.
Yeah,
Good to
first,
have you. Good to have
good.
you. Good
Well,
to have
thank,
you today.
thank
Yes.
you, thank you, thank you. I want to take first. Thank you for allowing me to be on your show again. I do appreciate your confidence in me, and the upcoming tax season is going to be pretty. It's going to be a little different.
Yeah, I know it is. And we're going to continue to do this all the way through tax season as well so that we
Cool,
can make sure we have everybody on the right page.
right? And it's a good thing that you do it on Sunday, even though
Right.
because that would be the only day I have off.
I understand that.
So, I want to tell everybody welcome to the 2024 2025 tax season updates. I do want you to first know that I cannot even begin to give you all the knowledge that I believe you need or can utilize on this one podcast because there's always continual changes and updates with the IRS and the new rules and laws and everything. But I'm just going to touch base on some of the things that I think are pertinent. But as always, I think Mr. Renfro always lists my name and number on the website here on the podcast. And so if you have any questions, please feel free to call me. I will answer any questions that I have knowledge on. If I don't have knowledge on it, I will obtain that knowledge and I'll get back with you. But right now I'm going to touch bases on some new things. The first electronic filing date will be between January 15th and January 30th of 2025. Then they will have, there's a lot of people right now, or a lot of offices that are offering tax season loans. I do want you to be aware of those things, and those are loans, but there are no guaranteed or guarantee on what you can get in those loans. Those loans begin January 2nd from most software holders. And what they do is the loan is a pre-season loan with based on the expected refund that a taxpayer may have. It's also based on your tenure with your preparer. Most cases, if you're jumping around and you go to a new preparer, you may find that you may not get the expected loan that you're looking for. So that loan ranges from $500 to $7,000. But again, that's based on your tenure with your preparer and your tenure with the software developer company that your preparer uses, and also based on the amount of money that is anticipated in that loan on your refund. Please keep in mind that that once that loan is applied for, and that tax return is submitted, it's not being submitted to the IRS. It's being submitted to the software company, and then the software company lends it to the bank for the bank to make their own discretionary decision based on what they think you qualify for, if you qualify for anything at all. But once that tax return is submitted, it is officially gone. You will not be able to retrieve it. You can't go back and file with someone else. That tax return is done. So you want to make sure that your tax return is accurate. I know a lot of people want to rush and get the loans on the onset, but please keep in mind that the IRS has this new, well, it's not really new, but they have this accuracy department that sometimes refunds get thrown into that department, and refunds can be held for a whole year or longer. So if you're anticipating getting a loan and rushing into an office to get a loan, and you don't have all your tax documents like your W-2s, because you have various employments in the 2024 tax year, then the IRS will know. Okay, and you don't want that to happen. I've had, a few new people that's come to me with that situation. So just be mindful that if you're applying for a loan, you are submitting your tax return. So a lot of people this year also have asked me, do I have to file? So if you receive only Social Security income, and then you do not have to file. If you're a single under 65 and you made anywhere between 10,000 or $0. Well, I'm not gonna say $0. I'm gonna say 10,000 up to $13,350. You do not have to file. You only have to file if you receive the premium tax credit. And what that is we probably hear it by another name, but it's listed under the Obamacare, pretty much. So when you get this marketplace benefit or the premium tax care benefit, the only way you would have to file if your income is under the threshold is if you receive that, and you have to reconcile that dollar amount. A lot of times that amount is being estimated, and when you file for it in January, like most have already done, they've estimated their income in November because that's open season for healthcare. So if you've applied for that and you estimate your 2025 income, but you underestimate what you may make, and so you may have to pay some of that money back that they gave you for assistance with the healthcare. So that's why I say although you may not have made enough money to file, if you receive the premium tax credit, you are required to file. I also want, if you were under 65 and had a dependent, if you made over $20,000, you would have to file. If you made under $20,000, you wouldn't have to file. You may ask me, why wouldn't I have to file? Income and deductions, that's what that's about. So your standard deduction would wipe out any tax liability you had if you made under 20,000 if you were filing head of household. So that's why I say you may not have to file. But I always tell you to make sure that you get in touch with your tax preparer and that you give her that information and you discuss that with her. Also, with additional news, there's a new tax bracket. Anybody making anywhere between $0 and $11,000 would fall into the 10% tax bracket. If you made anywhere from $11,600 to $47,000, you would fall into the 12% tax bracket. If you made anywhere from $243,000 to $609,000, you would fall into the 35% tax bracket. So the tax brackets are still there. The only thing that's been adjusted are your dollar income amounts. All things with the IRS are based on what they call COLA, cost of living adjustments. So, every year the cost of living adjustments go up for various reasons, various deductions, and also filing statuses.
So tell me, how much is the increase for this year, 2025, and for Social Security increase?
Oh yeah, I'm gonna get to that in a minute.
Okay.
But I'm gonna get to that in a minute. But then we have I kind of talked to Mr. Renfro about this earlier before we got live, but this is the Beneficial Ownership Information Report as set up by the Financial Crime Enforcement Network. What the acronym for that would be FinCEN. You have to have filed, you have a LLC, and you have to have filed your beneficial ownership report by December of this year. The breaking news is that effective November of 2024, that they have protested that, or they're still in litigation. So it's on appeal. So they're pretty much saying you don't have to while it's on appeal, but I would implore you to do that. It's not very hard to do, but you want to make sure you go ahead on and do that, because if you don't do that and that appeal is rejected, you're looking at IRS can give you a fast date to file it. You may have a preparer that's bogged down in taxes and clients, and they may not be able to get to that in a timely manner for you. And you want to make sure that you're not being penalized $591 per day because you didn't file it, where you can take 30 minutes out of your day and just file that report. So I would implore everybody to go ahead and do that report, regardless of this new update with the IRS saying that it's an appeal. Let me give you a little bit of explanation on that. So the BOI reporting is a federal requirement that must be completed within 30 days of any creation of a 2024 LLC. Any LLC that was prior to 2024, you have to December. So just keep those things in mind. If I'm going fast and you need some updates on that, call my office. My number is listed on the podcast here. Then we also have let me go back to here, another update. That's when it's on appeal. These are my notes. And then Mr. Renfro asked about the increase in Social Security. So there is a 4.4% increase in Social Security. What that increase pretty much means is in 2023, your wages were taxed on $168,000. So if you made from, let's say $13,000 to $168,000, you were going to be taxed on Social Security. And that tax was 6.2%. But the increase comes in once the dollar amount increases. So in 2025, that dollar amount is going to be $179,000. So if you made let's say you make $180,000, you will no longer be taxed on Social Security benefits as deducted from your wages with your employer. But that's going to be a significant increase for a lot of folk. That's going to be a significant deduction in your take-home pay. There are a lot of things I want to talk about, and that's why we included 2025. Although the updates I'm giving you is for 2024, I'm going to talk briefly on the 2025 updates. You probably heard this thing called sunset. Back in 2017, the IRS or the president instituted the Tax Cuts and Jobs Act. And that did a lot of changes to our taxes, that increased some things, that changed our tax brackets, that froze a lot of benefits for us. But toward the end of this podcast, I'll go over some of those things that are looking to expire in 2026. And I want to discuss that because it's going to make the difference in what we do as taxpayers and how we can reduce our tax liability and be prepared for that before that time comes. We have a new president in office, and most times when we got new between the change of the Democrats and the Republicans, there's a lot of things that happen. And so we just want to be mindful of that, and we want to prepare for what's coming. And I want everybody to also know knowing their tax bracket. So I went over that with a few minutes when I was discussing the tax liabilities. But let's say we made the difference in how this tax bracket how it affects us. If I was in a 10% tax bracket and I made after my deductions, I made I had $10,275 in taxable income. So I'm 10%, and then that means that I would owe the IRS $1,027 if I didn't take 1 cent of income tax withholding out of my pay, or if I didn't have a dependent where I can claim or qualify for some of those benefits, so that earned income credit and child tax credit. If I didn't do any of those things and I had a $10,000 tax liability at a 10% tax bracket, I would owe the IRS $1,027. The same token is if I was in the 35% tax bracket, I would be taxed on 35% if I reduce my taxable income to $2,275. There are a lot of ways we can reduce our tax liability. Most cases, if I were in the 35% tax bracket, I probably would never have reduced my income to $10,000. I'm just giving you some examples when I talk about these numbers. And then the news, which I talked about, and that's COLA. The increase in Social Security taxes is based on the cost of living adjustments. And the actual numbers are $176,100. So, we got the 6.2% Social Security, which we were taxed at $168,800. Now it's going to be increased to $176,100. That is deducted from our wages. And then we have Medicare, which is 101.45%. That's deducted from our wages. And then we have, let's say we have retirement benefits that's coming out of our wages. We have, we may have child support that's coming out of our wages. We may have a lot of deductions coming out of our wages. So in 2025, we want to be mindful of our tax bracket and what's going on with our pay. A lot of people have told me that they only I don't look at I don't get my paycheck stuff. They just send it to the email. Well, it would be beneficial to you that whether they send it to the email or they give it to you in your hand, it would be beneficial to you to look at your pay stubs to make sure that you're taking adequate withholdings out, and just to compare the difference between 2023 with take-home pay and 2024 take-home pay. It's going to be different. Nothing, you probably won't get a raise or anything, but because of the new tax law changes, you're going to get less money. Okay, so be mindful of, be diligent and look at your pay stubs and not just look at the deposit that they're putting in your bank for the checks that you make. Okay, and then a lot of times, a lot of people don't look at it at all, and then at the end of the year, they come to my office and I didn't change anything. I don't know why they only took out $1,000 in withholdings. Something had to change somewhere.
Right.
Because they didn't look at it for the entire year. And now we at the end of the year, it's nothing they could do but end up with a tax liability. Meaning when I say a tax liability, I mean that you have to pay the IRS some money. Okay, right. Because you have more income than deductions. And a deduction is federal withholdings, but that deduction is pretty much set up by you. Okay. And then in 2024, like in Texas, they call it spousal support, but around the world, in most places that have alimony, it's called alimony. Alimony used to be able to be deducted by the payer and not included in income by the receiver. So we can no longer take a deduction for alimony payments. Okay, but again, in Texas, they don't have alimony. It's called spousal support.
Right.
And so we need to be mindful of that. So that used to be a deduction that, a lot of high earners would take into consideration. So they didn't have, but you don't have that anymore. And then there's this earned employee retention credit. I think I touched on that, but this started back with COVID. So 2019 to 2022. They had there were the PPP loans, and believe it or not, that's what a part of the thing that sparked that BOI. And they had a lot of the employee retention credits where if you were an employee and you had employees, you got a tax break on the payroll taxes that you paid for having those employees. That was incentive from the IRS to put monies back in small businesses to help them to, sustain during that COVID time. Well, there are also a lot of stuff on social medias and things like that were telling people all they had to do was have a business and have employees and they qualified for this credit. That wasn't so. You had to have been affected by COVID in some manner, meaning your business had to been closed or by law, by mandate by the state or the county that you were in. Most people, they didn't do that. And the people who were promoting these things on social media, all these scams that are out there, did not tell these people that. So they went out and got these ERC credits. And so now the IRS is threatening to make you pay all that money that you got back. And now how they're going to select the people that that's going to have to repay this monies, I don't know. But I do know that they are serious about this repayment. There's no loan forgiveness. There's no penalty forgiveness. They're even giving people the option to not penalize them and if they return all the money that they got back fraudulently. Okay.
Wow.
But if you don't, then you have to pay all that money plus penalties and plus interest. So you want to talk to your preparer too, because they were the ones who pretty much knew the rules and the laws as associated with this retention credit, and they know whether or not you were allowed or qualified to receive those monies. I know those monies are gone and people have already spent it and stuff like that, and they're going to say, well, why didn't the IRS stop the people from saying that on social media? Well, the IRS is not, that's, why didn't we, if we want to ask that question, well, why didn't we research it enough to find out if we qualified for that or not? Because if you research that credit, the first thing said you would have to been affected by COVID, meaning the shutdown of your business. Because the qualifications didn't change. It was just the people out there that were soliciting the business and charging people a lot of money to apply for these credits for them. And they're going to go and they're going to get everybody involved. So it's not going to just be the taxpayer. It's going to be the tax professionals as well. Okay. I didn't do any of them for my clients because a lot of them were not affected by this. And then we have the 1099K reporting, and that's the reporting for small businesses, people that receive payments through Venmo, Cash App, Square, like that.
Stripes.
So,
yes.
So before then, the requirement to get this 1099K was $20,000 or 202,500 transactions if you didn't get $20,000. Okay. So you said if I didn't make $20,000, but I had 2,506 transactions, then that 1099 would be coming my way. So now that's changed. Now it's $5,000 and 250 transactions. So a lot of people are going to be getting 1099s.
That's the 1099K, right?
Right. That's small businesses or businesses who take payments through those channels.
Okay.
And that's why in the onset, I was talking about when you go apply for these loans and with these tax loans, and the 1099s are not to be disbursed until February. W-2s have to come out in by January 31st. But not everybody sends the W-2s out. Then people move. So if you move and didn't update your address with your prior employee, you could be getting W-2s at the wrong address. W-2s are pretty much, they're not always forwarded. So, and then you forgot that you work at this place. And, then you go file this return and it's inaccurate. You will be charged the inaccuracy penalty, not your preparer. So you need to make sure that those things, you wait for all your returns, you wait for all your tax documents. So, and you also, if you receive monies, I know it's some ambiguity on whether or not, what if I receive income from my family from Cash App or money that people owed me that's not associated with business transactions? Well, your preparer should be able to separate that income. But what I would tell you to do is to create you a Cash App for personal and create your Cash App or a portal for business. You really should never be mixing your business and your personal stuff together anyway. But there is a way to back that family transactions out if you have to. But you need to make sure the person who does your taxes are aware of that. Sometimes we don't inform them of that, but we need to make sure that they know everything they need to do to file your taxes accurately. Then there are additional disaster extensions for 2024. So some even Texas, some folk that were affected by the disasters that happened out in 2024, their time to file their taxes has been extended to May 1st of 2025. You know who you are. You know you if you were in a county that was affected by a natural disaster, and some of the folks in the Jefferson County area were affected. But you had to have been affected by the disaster, and you also had to have filed that extension prior to in April when you filed your automatic extension. So if you didn't file it then, and there's nothing you could do. But so pretty much the April filing date that gave us extension to October are now extended to May if you were affected by the disasters that happened in Texas. And they call it has to be a disaster that's deemed by the IRS or your state. And then we have the filing statuses. So we have filing status increase. So a filing status is this: is single, married, or single, married, filing joint, married, filing separate, head of household, or married, and following a qualified widow with a dependent child. The IRS definition for those filing statuses are different than we would think ours are, especially the head of household. Head of household does not mean that you are not the head of your house and that you are not the person that's paying all of the bills and feeding the children. That doesn't mean that. Head of household, it has a set of rules that's set by the IRS. First and foremost, you have to have a dependent in order to file head of household. Secondly, you have to have actually paid more than 50% of the upkeep of that home. Okay. And that's inclusive of some folks receive Medicaid, some receive government benefits for food stamps and things like that. If you're not paying for the food, and if you're not paying for the medical care, and if you're not paying for the rent and stuff like that, because you're getting subsidies from the IRS, then you may not qualify for head of household. But that's really not, you really don't want to be too concerned about that, because it's just a filing status. In most cases, your tax refund is not going to change. But in a lot of cases, we give our preparers a lot of grief because we didn't file that filing status. Just keep in mind that it is just a filing status that's set by the IRS. And single is the same thing. For single, the filing status is $14,500. For married filing joint or widower is $29,200. And for head of household is $21,900. Now, you would ask me, how does that affect my taxes, and why would I be so concerned with that? Initially, I talked about income, watching your W-2s, making sure you receive all your W-2s and income statements before you file your taxes, because you got income minus deductions. And the first part of the deductions that is subtracted from your income is your filing status. So if I made $100,000 and I was single, automatically $14,600 would be subtracted from that number. Okay. And it's going to go down further and further as I qualify for certain credits. So I want you to keep that in mind. So your filing status matters. It's one of the first things that they deduct from your income to determine your tax liability at the end of the road, as I call it. Meaning at the end of the tax return when we're talking about liabilities and income minus deductions. And then we have this thing called retirement. What is retirement? Retirement accounts were created to encourage folks to save money for their age of retirement. They got different types of retirement accounts. We got IRAs. We have simple retirement accounts. We got traditional IRA accounts. And those things increase mostly every year. So it used to be last year it was about 65,000, and now it's 6,500. I'm sorry, and now it's 7,500. So if you have a traditional IRA, or you can tuck away up
Mm-hmm.
to $7,000 or $7,500, and if you were over 65, you can, well, over 50, you can tuck away more than 8,000. When I say tuck away, you can take that money, have it deducted from your payroll, put it in a qualified retirement portfolio, and that reduces your taxable income. So if I were, and then if I made 100,000, that's just a simple number that I use. It's easy to do the math. And I made 100,000, and I was able to, if I had a traditional IRA, that's what I get when I'm employed. An IRA, individual IRA, is what I do separately from employment. For employment, I could put away 23,000, so that $100,000 would be minus 23,000. So I still made 100,000, but because I put 23,000 in a retirement account, I'm only going to be taxed on the difference. So I think that's what, 87, if I'm doing the math right. So that, and then if I had 87, and then my filing status was married filing joint, then off that 87 would be 29,200. So now my tax liability is even more deducted, even more. So we want to make sure that whatever we could do to reduce our taxable income, we do. So, and at the end, that helps us in what we have to pay back.
Mm-hmm.
A lot of people take out the right amount of federal withholdings. A lot of people do not. A lot of people say they need their money throughout the year, but you got to take in mind, the IRS that's not how they work. We're a pay-as-you-go system. So they require you, as you make the income, you pay the taxes on it. And those are people that are wage employees. Those are not I'm not talking about the people who are self-employed. They, of course, have to pay their taxes minus their deductions or minus their expenses at the end of the year. Some people pay estimated taxes, some people do not. But for the retirement, as I was saying, that for a 401, you can contribute up to 23,000 and 30,500 if you're over 50. And then for the traditional IRA is 7,000 if you're under 50 and 8,000 if you're over 50. And they allow this extra monies if you're over 50 for those of us who didn't have the type of business or weren't making the type of money to contribute to a retirement account before those ages. Some of us didn't know about them. Some of us just could not do it. So take advantage of contributing those monies. Take advantage of HSAs, health savings accounts. Take advantage of FSAs, family savings accounts. If you have a job and your job offers those type of benefits, take them. For the HSA, that is, I can contribute up to $5,000, a little over $5,000 for healthcare benefits on my job. Now that's deductible, and that's not included in income. If I used it to pay for health expenses, co-pays, medical expenses, and things of that nature. But you have to make sure you even bring those forms in to your preparer, because they send those forms to you. They send a form to you that tells you how much you contributed, and they can send a form that tells you how much you distributed. So how much you put in and how much you took out. So that's why you want to be mindful of not rushing into the tax office, just making sure that you have all your tax documents and filing it one time, and not having to have the IRS come back with you and charge you monies because you filed early and you didn't report all your income, and now you have an increase in your tax liability.
So you advise them to just be still and wait until maybe the mid of February before they
right.
file their taxes.
At least, yeah. Some people receive all that. My advice is to wait.
Right.
Some people feel like they can't wait, but I especially folk that qualify for earned income credit and things like that, and who would qualify for that loan. I want to make sure that they know that the IRS once your return gets thrown into an accuracy department, it takes a long time for it to come out of there. They're not
I'm
even
telling you.
processing your return.
I'm telling you.
Yeah,
It's almost a year.
Long time. Almost,
Very
yeah.
long time.
I'm working with someone now. It's a year. I
Yeah,
mean,
it's been a year for me. I had my identity stolen, and I had to file taxes with addendum, and
mhm.
it has taken over a year, and I have not received it yet.
Yeah,
So
it's so,
it's very stingish, but
yeah,
that's gonna have to wrap us up right for this evening. But we'd like to come back again next month on as we continue to go through the tax season, the beginning of the tax season. I'd like you to talk about child credits too as well, so they can be aware of that and have knowledge of what to do about it. Is it? I'm saying it right? Child.
well, it's the earned income tax credit, and then you have the child tax credit, and then you
Right.
have additional child tax credit. Yeah.
Right. Yes, let's do that. And we want to thank Miss Vanessa Washington tonight, owner of Guarantee Express Tax Service. And you can reach her at 409-892-1118 anytime. And we want to thank you all for watching and listening to our program that we've been doing for the last 4 years, and it has been great. And I want to thank you all again, and I want to wish you all a Merry Christmas and a Happy New Year. We won't be back on until the first of the year, but we want to wish you that, and may God bless you. And Vanessa, God bless you too as well. And I thank you so much for being being part of my program. And it has been a pleasure having you and giving us this knowledge.
You're welcome, and Merry Christmas to everyone as well. Be safe.
Yes. Be safe, everybody. We love you. God bless. Thank you.
Thank you for watching Knowledge is Power Podcast Live. Be sure to like and subscribe to all Knowledge is Power social media pages.